Why the bull market is doomed and why you should sell now. As of March 11th, 2025, cracks are widening, volatility is spiking, the Invesco QQQ Trust QQQ is plunging, and the S&P 500 teeters on the edge of a correction. Investors who've ridden this wave are staring at a stark reality. The forces propping up this rally are crumbling, and the smart move is to sell now before the inevitable crash. Rising tariffs, overvalued stocks, a hawkish Federal Reserve, and a brewing global trade war spell doom for the bull, and holding on could cost you dearly. President Trump's tariff escalation is the first nail in the bull market's coffin. With 25% duties slapped on Canada and Mexico, a 20% hike on China, and threats of more against the EU, the U.S. economy is choking on its own trade policy. Tariffs aren't just taxes, they're a wrecking ball to corporate profits and consumer wallets. Goldman Sachs estimates a 10-15% effective tariff increase could slash S&P 500 earnings by 2-3%, and that's before retaliation kicks in. Tech giants like Apple and Nvidia, linchpins of QQQ's 50% plus tech weighting, face higher costs for components. Think Chinese chips or Canadian assembly parts. They'll either eat the hit, shrinking margins, or pass it on, risking sales in a price-sensitive market. Retaliation amplifies the damage. China's counter tariffs on U.S. soybeans and tech exports, already down 50% since 2018, gut rural economies and hit firms like Qualcomm. Mexico's threatened auto levies could tank Ford and GM, while Canada's energy and lumber duties squeeze construction and oil. The IMF warns of a significant disruption to global trade, and Deutsche Bank's George Saravelos calls it a recessionary shock. Supply chains, still fragile from COVID, can't pivot fast enough. Businesses will cut spending and jobs, dragging growth into the red. The bull market thrives on expansion. Tariffs are contraction's harbinger. The market's valuations are a bubble begging to burst. The S&P 500's forward PE ratio sits at 21, far above its 15.8 historical average, while QQQ's tech-heavy basket flirts with 25, levels last seen before the dot-com crash. The AI euphoria of 2024, driving Nvidia up 180% and Tesla 90%, was a speculative fever, not a sustainable trend. Now, with Nvidia wobbling, down 5% in a week, and Tesla facing tariff-hit margins, the growth story's unraveling. X posts note QQQ nearing its 200-day moving average. A break below could trigger a 10-15% technical sell-off. This isn't just tech's problem. Consumer staples, industrials, even financials, sectors that propped up the bull, are overstretched. Earnings growth at 5% year-over-year per FactSet lags the 15% stock gains of 2024, meaning prices outpaced fundamentals. A Barclays model suggests a 5% earnings drop, plausible with tariffs, could slash fair value by 10%. The bull market's been running on fumes of cheap money and hype. Reality's catching up, and the fall will be steep. The Federal Reserve, once the bull's guardian with zero rates and QE, is now its executioner. Inflation, stoked by tariffs and supply shocks, refuses to die, hovering at 3.5% versus the Fed's 2% target. Powell's late 2024 pause on rate cuts has morphed into hawkish hints. A quarter-point hike could come by May if tariff-driven price spikes hit. The 10-year Treasury yield at 4.5% and climbing hammers growth stocks. QQQ's top holdings lose 2-3% in value for every 50 basis point yield jump per UBS. Higher rates choke the bull in two ways. They raise borrowing costs, stalling corporate investment, and they make bonds more attractive than stocks, siphoning capital. The Trump put, a belief in market-friendly policies, has evaporated. Ex-traders like a macro-alf lament no Fed backstop this time. With $6 trillion in corporate debt due by 2028, refinancing at 6% instead of 3% will bankrupt weaker firms. The bull market's low-rate lifeline is severed. Selling now beats riding this debt wave down. The global economy, a key bull market pillar, is buckling. China's growth, at 4% and slowing, can't absorb U.S. exports if tariffs kill demand. Europe, mired in stagnation, Germany's GDP flatlined in Q4 2024, faces its own tariff threats. Emerging markets, hammered by a strong dollar, up 5% since January, can't pick up the slack. The World Bank slashed its 2025 growth forecast to 2.5%, citing trade fragmentation. U.S. multinationals, 40% of S&P 500 revenue, will see overseas profits shrink as global demand falters. Oil's another wild card. Canadian crude, 60% of U.S. imports, faces 10% tariffs for now. Escalation could push Brent to $100 barrel. Higher fuel costs hit airlines, retailers, and consumers. Delta's stock, for instance, could drop 10% on a 20% oil spike. The bull markets ignored these risks, but they're crystallizing now, selling locks and gains before global contagion spreads. Investor psychology is flipping bearish. The VIX, Wall Street's fear gauge, spiked to 25, double its 2024 average, signaling panic. X-chatter from our stock MKT News to retail traders screams, top is in. The S&P 500's 3% post-inauguration slide per Reuters killed the Trump rally myth. Technicals agree. QQQ's RSI hit oversold territory, but momentum's fading. A classic pre-crash signal. The S&P's 50-day moving average crossed below its 200-day last week, a death cross last seen in 2008. Algorithms will amplify the rout. Selling now avoids the stampede. Timing matters. The bull's not dead yet. It might limp through Q2 on tax cut hopes or dip buying, but the risks outweigh rewards. A 10-15% correction looms. A 20-30% bear market isn't crazy if tariffs escalate and the Fed hikes. Cash preserves capital. 4% Treasury yields beat a 10% stock loss. Historical crashes 2000-2008 hit hardest when euphoria ignored fundamentals. Today's parallels, overvaluation, policy shocks, global weakness, are glaring. Selling now isn't panic, it's prudence. Bulls cling to low unemployment, 4%, and consumer spending. But jobs lag. Tariffs and rate hikes will cut hiring, and consumers are tapped out, with credit card debt at $114 trillion, Fed data. Corporate buybacks, $1 trillion in 2024, propped up prices. They'll dry up as cash flows shrink. Tax cuts, stalled in a gridlocked Congress. The bull's lifelines are fraying. Hope isn't a strategy. The bull market's doom isn't a hunch. It's a forecast baked in data and history. Tariffs gut profits and spark inflation. Overvalued stocks face a reckoning. The Fed's tightening, not easing, and global growth's stalling. Sentiment's sour, technicals flash red, and the exit's narrowing. Sell now, lock in gains, dodge the crash. The bull's final roar is fading. Don't be the last one holding the bag.